And there's actually a term for this, right? That whenever you introduce a new device or mode of transacting financially, it's introduced into a pre-existing monetary ecology, which has a certain institutional and regulatory context. There are certain social relations on which it works, there are certain social norms, and people also have certain monetary repertoires, which means that they earmark certain kinds of currency for certain kinds of activities, right. So, cash might be for things that cost less than a certain amount, or they might be for buying vegetables, right. Frequent flyer miles, obviously you are restricted from using it in all places, only some places will accept it. So, whether it is for institutional reasons or social norms, people keep aside certain kinds of money for doing certain kinds of things. So, in fact, anthropologists, I do not have time to go into this in great detail, but anthropologists have found over time that even the same currency, right. So, you might have dollar or rupee bills, but people will keep some in a box which will indicate savings. They will keep some in their wallet, which is for spending. They might keep some in their pocket, which is only for buying tickets, and so on and so forth. So, we have a fairly sophisticated and evolved way of thinking of bucketing our different payments and expenditure and so on, right. And as researchers of mobile money, I think it's very important to think about what is the ecology and repertoire to which you are introducing mobile money. And I think the thing to keep in mind is also that people do and have always continued to use different forms. So, instead of thinking about cashless, maybe we should think about how does cash get incorporated, what are the advantages that it offers, what are the things it is continuing to be used for, and in what cases does it not make sense for cash to be used, or for what kind of people is mobile money a better way to transact, right. So, rather than thinking in terms of the binary of cashless and only cash, I think the whole point here is that we are enhancing people's choices and the kind of modes that they operate in. So, that is one thing I would like you to keep in mind going forward. Again, coming back to what is it that cash can do, right. There are very, very interesting examples. For example, visibility, right. So, there's a research group called Institute for Money Technology and Financial Inclusion that I work with, and they have fascinating stories of how people continue to use cash. So, one of the things they found in the Philippines was that migrants, when they came back home for say festival holidays or something, like bringing back cash. If you transferred cash on the phone, it wouldn't be visible to the rest of the village, right. So, you wanted to say that here's how much I have made as part of my work which I do as a migrant, and this is what I have brought back in lieu of that work, correct. So, there are some performative acts of which cash is a part. So, I think that is very important to think about. Another way to think about this is our housewife from Kanpur, who was basically saying that in her case the cash was invisible, right. As long as she kept her savings of money in cash, she didn't necessarily have to account for them. She wasn't constantly traceable, but with bank accounts and presumably with mobile wallets, that is traceable. So, thinking about these questions of how visible cash is and whether you want it to be visible or not in a particular scenario is important. There is also the cost of using, right. Everyone accepts cash. So, there is that, and it is not just that people will just take cash at par, right. You do not pay fees to use cash. With a lot of your mobile wallets or other means, there might be fees, and the fees might sometimes be hidden. Not everyone might understand what fees you are paying for each transaction. With cash, you know that that is not going to happen, right. There is also the other kinds of costs are also time and learning curve. You do have to learn how to use other kinds of things like mobile money and so on and so forth. Whereas with cash, I think historically everyone knows now how to use cash, how to pay it out, etc. There is also another aspect of cash which I am sort of interested in, and I will probably do more research on going forward, and that's your ability to negotiate with cash. So, I'm sure you have also seen this in everyday transactions, but I'll give an example from my research again among the fishing community in Kerala. So, one of the things that happens is that fish are auctioned in Kerala, right, in a public auction. Now, what happens is that fishermen will bring their fresh catch, lay it out on the sand, and someone will auction out that fish, and the person who comes up with the best price gets to buy that fish. A lot of the buyers are small scale fish vendors who happen to be women, right. Now, these women will come and they will decide on a particular figure, right. So, he'll announce, say, I don't know, randomly 700 rupees, 1, 2 and 3, and a 3 one person's taken it, right. And she will maybe 700 wasn't the right figure. So, she'll say 720 is what they have decided on. Now, this woman will come, look through her wallet, and she'll say, you know, actually I don't have 20 rupees change, right. So, it's not that this will happen every day, but every once in a while these kind of negotiations do happen, right. So, this might be genuinely because someone doesn't have change, but sometimes it's also a way of saving a little bit. And I'm not taking like a moral stance on this. My point really is that it becomes cash and change become a way in which people can negotiate with each other and slightly have a little bit of leeway to do that in a way that other kinds of monetary instruments maybe don't. Because if you can send an exact amount, where would the space for negotiation be? Anyway, this is something that I'm interested in going forward. Again, coming back to the features of this whole remittance and payment sort of landscape, we have already seen that agent networks are critical. But one thing to think about is then how are these networks regulated, right? What prevents, how do you prevent, say, fraud? What about someone who takes money and just runs away? How would you deal with something like that? The other point is also, you might remember that I had said one of the things about mobile money agents is that they are from the local community, which means people trust them. But the flip side of this is that obviously then they have a very specific social position. They might belong to a particular religion, a particular caste, etc. And all the kinds of discrimination that that flow from that are likely to be reflected in their transactions. And there have been documented instances where this happens. There's also the question of physical infrastructure, right? So, one of the reasons that people speak of moving to mobile wallets is because the earlier banking infrastructure wasn't that great, the banking physical infrastructure. But of course, mobile wallets also need their own kind of infrastructure, whether it's electricity, network connectivity, or roads to reach agents. So, all of these again have to be kept in mind. Then we come to the ownership of the mobile phone and who gets to use it, right? And here's where family and gender dynamics typically play a huge role. Because if your mobile phone is shared, what does that mean in terms of how much cash you can, how much M-Pesa transfer can happen to your phone? Is your family comfortable with that? Who's transferring you money, etc. So, it might again be used as a surveillance device, again something to think about. And finally, like I pointed out earlier too, what kinds of data trails are you creating and how is that being used? All right. So, with this I want to move on to digital credit, which is another space in the whole digital finance landscape which has been getting a lot of attention, right. So, digital credit involves a lot of different types of entities and institutions increasingly. In a typical digital credit offering, a mobile phone operator will partner with a financial institution to provide small short-term kind of loans, and they will do this directly. They will directly offer this to customers over an existing monetary sort of ecosystem. Two of the examples I have here are M-Shwari and Lendo. These are both part of this whole new age digital credit sort of an ecosystem. Now, what was the rationale? The rationale was that digital credit lowers transaction costs because these loans can actually be dispersed through mobile money, and this can happen pretty instantaneously, right. So instead of earlier situations where a physical banking infrastructure had to be leveraged to do this, loans can be disbursed much more quickly in this case through mobile money. The other thing is also the reason this can be done quickly is because earlier digital credit and loan approvals will typically require in-person vetting of the person, right? So will they be able to repay this, etc., was something that people verified face to face by traveling to where they lived or where they worked, etc. But with digital credit, it's more immediate. And why is this? Because and we'll come to this later, because of a bunch of new sort of algorithms and so on, whereby you can, companies are trying to detect people's credit worthiness using other means. Then third, loans can also be processed remotely without requiring the customer to visit a store or agent in person. Again, saves time, possibly transaction costs. And finally, since the giving of credit and loan is typically tied to people's credit worthiness or a credit score, and many people don't have this kind of credit score, how do you really vet people for their worthiness? And this is what I was saying earlier too, is that there are now a bunch of innovative ways in which people are trying to do this. And very often in doing this, they use very non-traditional data. And what do I mean by this? Instead of necessarily, so if earlier if you applied for a loan, people might look at how much you earn, which would be available to them, say, from your bank. What is your credit history? What have you been spending on? Which might again be available with a credit bureau or possibly your bank. Now, when this doesn't exist, these new companies have started looking at other kinds of details, like how much airtime do you load up, right? And are you able to pay for that? Have you been paying bills using mobile money? Those are the kinds, those are one kind of things that get tracked. Other kinds of usage might also get tracked. So for instance, most lenders associated with the telecom industry will use the applicant's history of mobile phone usage, airtime purchases, data use, etc., as well as mobile money transactions. When the applicant has an app installed, this will also collect things like GPS data, contact lists, and so on and so forth. For example, Lendo, which I showed you, it uses people's contact lists, how frequently they are in touch with others on their contact list, etc., to figure out the social network within which they operate, right? And they use this to come up with a score which measures their credit worthiness. Some other companies even use quizzes to figure out your credit worthiness. Others use psychometric analysis. So they might try and figure out the kinds of things you say on, say, your social media account, which might actually not be directly connected to your finances, but it helps them build up a certain kind of profile of the kind of person you are, which they then link to credit worthiness. So you can see how different this is than earlier ways of offering credit. And obviously, as with anything new, this both has new features, but also there are things that you're concerned about. A recent Scroll article, for example, says online firms can give you quick loans, but make sure you're tweeting the right things. Because basically what they are using to determine your credit worthiness is the kinds of things that you say on, say, your Facebook or Twitter account. So one of the things that we really need to keep in mind, given this burgeoning space of digital credit, is the kinds of algorithms on the basis of which they operate. Now, as you have already learned from, you must have from Srisha's session yesterday, systematic biases often get encoded into algorithms, right? So in this case, for instance, someone's digital trail might be very, very weak because they either can't afford to or just don't use certain kinds of digital technologies or don't purchase airtime as often, etc. Now, you might use this to come to very erroneous conclusions about their credit worthiness. So there is that. What sort of makes this even more problematic is that these algorithms are often opaque. So you don't necessarily know on what basis they are scoring you. So that is also an issue. The other issue with digital credit is precisely because it's so quick. You can very often call up and get a loan within a matter of hours or days. Now, what this means, combined with the fact that there is no in-person vetting, is that first-time borrowers might actually over-borrow. So, they might borrow more than what they can repay. They might have done it with the best intention, but they are unable to repay. And because the credit agency hasn't done the same intensity of due diligence, maybe it's basing it on metrics that we don't know how reliable they are, they're all pretty new. So, given all of that, there is a risk of over borrowing. There's also the risk of agent fraud, and this happens for multiple reasons, one of which is that very often people will give agents their credentials. This might include their mobile money, wallet credentials, etc., because that makes things easier for them. Now, is this used to perpetuate fraud? There have been cases, but this is something to watch out for. And finally, again in light of your previous session, all of this also has privacy implications. So, if I say something on Twitter or on Facebook, why should that be taken into account when I am doing my financial transactions? That's the question that you really need to ask. So, one thing I also wanted to flag was, though I was basically going to focus on payments and on credit today, there are obviously many other slices to the digital finance pie, as it were. One of them, especially in the Indian case, has been this question of welfare payments, right. So, people's earnings can also come in a digital form, and one of the things we have been hearing about is direct benefit transfer. So, this whole space of entitlements is also definitely worth studying, and again speaks to all of these issues that you learnt about yesterday, right. So, the rationale for using digital transfers for entitlements is that the costs of disbursement are lower, they are just directly transferred into your account, it is possibly quicker. There is also the promise of reduced corruption. So, the idea is that if you do not have to deal with people and cash and your money goes directly into your account, this reduces corruption. And of course, linked to this is the fact that your transactions can be traced. So, you know where all it goes in a way that you cannot trace cash. Also, the other thing is we again have issues around privacy and so on, right. So, direct benefit transfer or conditional cash transfer is often based on, do you do certain things, and in return for that you get transferred certain money. And again we have seen this whole thing around Aadhaar, right, whereby people have to part with certain kinds of details with their lives in order for them to get certain welfare benefits. So, this trade-off between getting certain benefits and parting with your data, right. So, that should definitely be something that we think more deeply about and think about what are these trade-offs for different demographics and so on and so forth. So, just wrapping up and sort of thinking of ways forward, especially in the space of digital finance and financial inclusion, one of the primary things we really need to think about is this whole vision of inclusion, right. As we do more and more research in this space, we realize that the people that we call financially excluded might not be part of formal financial networks or banking institutions and so on and so forth, but actually they have been financially active. Maybe that is obvious, but I think it is worth stating. Now, they might have used different kinds of entities, institutions, those might have been more expensive. Now, they have maybe a wider variety of entities they can go to, and this has reduced costs. All of that might be reasonable, but I think it is worthwhile thinking about the pros and cons of including people into formal networks, right. As much as it offers benefits, you could argue that some of this also means that they are exposed to certain kinds of risks depending on how the formal financial sector works, which might not have been the case earlier, right. So, we should really think, as some scholars have recently pointed out, maybe instead of thinking about financial inclusion, we should really be thinking about financial equity or justice. and then think about what are the implications of that for how you design products or policies, etc. So that's like a meta level product, meta level sort of insight. But the other more ground level thing is that very often digital finance or mobile money, etc., are sold on the promise that it's direct, right? It disintermediates is a very popular word. And the other things also, it's dematerialized. So that's the whole conversation around cashlessness, how we should move towards cashlessness as a desirable goal, right? But maybe from what we have seen, what we should really be asking is what kinds of intermediaries are useful, who are they useful to? Similarly, what kinds of material artifacts are useful in how we financially transact. This might include cash for a variety of reasons, right? So thinking carefully about the nature of mediation and the nature of materials that we use to transact is much more productive than aiming for disintermediation or dematerialization. Finally, and this is linked to the point about financial equity or justice, we have to confront the sources of social stratification, right? So it's people who are least likely to have financial footprints might also not have digital footprints. And if your credit scoring algorithms, for example, are focused exclusively on digital footprints, what happens to these kinds of groups of people, right? Women have been a classic case. Their credit histories were not known earlier, but now given how mobile phone access to them is restricted in many communities for a variety of social norms or financial economic reasons, what does this mean for their credit score going forward, right? So these are all things that we need to keep in mind if our primary goal is to look at social stratification and to change that. Like I said earlier, this is a vast space. People have written a lot about this. I just have an indicative reading list here. I have drawn material extensively from this in this presentation. I'm happy to answer any questions that you might have about this session or about digital credit or payment in particular. But I hope these are issues that you continue to engage with. I hope you found this session productive in thinking about algorithms, privacy, and identity in a very specific domain of activity that we call digital finance. My email is on the screen, so feel free to write to me. And thank you for listening to this long monologue. I would have preferred for it to be more interactive, but unfortunately that couldn't happen. That's all from me.